Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so we're going to talk about this article. The U.S. housing market may be trapped in a prolonged freeze.
Okay, and in honor of that, I am wearing white.
In honor of that, she's wearing white. We flew to Alaska to take a picture of Juana standing in front of an igloo just for the thumbnail. That's how dedicated we are to the accuracy and realism of this channel.
Okay, there you go.
And everything, okay? It says U.S. housing market faces ongoing problems from high mortgage rates and limited supply. Okay, let's first talk about that last phrase. High mortgage rates, limited supply. All other things being equal, okay? If I had said in a normal market, over the next year, mortgage rates would double, okay? What would happen to housing inventory? All other things being held equal.
Well, you would think that houses would sit on the market longer. You would think that the amount of inventory would grow because houses would stay on the market longer because buyers couldn't afford them. But that's not what happened.
That's not what's happening. So we have kind of a couple things happening here. Let's go through the points of the article. We'll explain this. I have a theory why home prices are still going up right now with 7.5% interest rates, okay? All right. Fannie Mae economists projected in a revised forecast that stagnation in the housing market could last into 2024, whether the economy avoids a recession or not, okay? So they really don't care. They're not really focused on whether there's a recession. They're just focused on the high interest rates and the lack of buyers, okay? And lack of inventory as well. So talk about that.
I don't think it's a lack of buyers. I think it's a lack of sellers.
Oh, it's a lack of sellers. So talk about that. You're a seller. You have a 2.9% mortgage right now on your house. And you're maybe thinking about moving to another city. Okay. What are the headwinds to moving to another city?
Well, so, moving is stressful, right?
Okay.
So you've got all that going on. And you're moving to another city, and you're going to need somewhere to live. So you look for a place to maybe rent or buy over there, and then you've got this house over here. Now, this house over here that you'll be leaving, you have two choices. You have choice number one, you sell the house and you move the equity to wherever you're going, which is traditionally what people have done. Or choice number two is that you keep this house and you rent it out, and the difference between your mortgage payment and the amount of rent that you get to pocket and put toward your new mortgage payment. Now, if you do not need the cash for your down payment for your new place, what you're probably going to do is rent out your current place, go buy the new place, take that difference between the mortgage payment and the rent, and use that toward your new mortgage, understanding that down the road, you'll be able to refinance that new mortgage to hopefully a better interest rate, and things will be hunky-dory, and now you'll have two properties that are growing in equity, and you're doing a little bit of wealth building, which is a good thing.
Okay, but that exactly explains the problem. The person isn't selling the house.
That's
historically,
right.
And let's talk about the last 20 years. Interest rates have declined slowly from 1983 until last year. So for 37 years, basically interest rates trended down over long periods of time. So if every 7 years you were selling a house and buying a house, you were trading in your 12% mortgage because interest rates were now 10%. So you were going to get rid of that mortgage, sell the house, extinguish that 12%, go buy a new house at 10%. And then you would sell that 10%, go buy a house at 8%. And then you would sell that 8%, go buy a house at 6%. And then 4%. And then maybe you refied, or maybe you did another purchase. Now you're at 2.5%. But you're not going to do it in the opposite direction.
Right.
So you have one of two choices. One is don't move. So say you're moving from San Diego to Vegas, okay? And you get here and go, God, there's not a lot of houses on the market that I would really want to live in. So, and I don't really want to sell my house in San Diego because I've got, 2.9% interest rate. And I'm only paying $1,500 a month mortgage, but I get $3,000 a month rent. So maybe you just say, you know what, I'll just take whatever cash I have, come find something in Vegas maybe, but I'm not getting rid of this house. Okay. If you do get rid of the house, you better be able to pay cash because you don't want to extinguish a 2.9% loan and then create a new loan at a higher rate, right?
Right, and there's more to it than that. I mean, if you've got a 2.9% loan, you can't. There's no way that you can reproduce that, right? So you can earn more money by not extinguishing that loan than you'd be saving by extinguishing that loan. So it's a little more complicated than that. But as always, put pencil to paper and figure out what works for you.
Here's the thing. The average person has never had a very good way to play arbitrage against mortgage rates. And now they have a great one. They've got this ridiculously cheap loan that they'll probably never get again. And they've borrowed this money on an asset that's appreciating far greater than what they borrowed. It's like this. There are so many people out there saying, if I would have known, I would have bought like 100 houses at 1.9%. I just met somebody. He said he had a 1.9% mortgage on his house. They bought in San Diego. 1.9% is his mortgage. Now I think it's a 15 years, but still it's 1.9%. And because the rate, if you could borrow money at 1.9% and get a 5% return, you would do that as much as you possibly could, right?
Right, which is my point.
Okay. Here's the next quote from the article. Regardless of whether a soft landing is achieved over the coming year, we expect existing home sales to stay subdued and within a tight range. Now, here's the thing. People are characterizing this as, well, the real estate market is so bad right now. Nobody wants to buy, so there's just not many sales.
No. There are more buyers than there are sellers. There are just very few transactions because there are insufficient number of sellers.
Okay. Next quote. Existing home sales have already tumbled 2.2% in July from the previous month.
Okay. Existing home sales as far as transactions, not as far as values.
No, prices are up July over July nationwide. Annual rate of 4.07 million units, according to the new data released Tuesday by NAR. On an annual basis, sales of previously owned homes are down 16.6% when compared with the same time last year.
So they're down 16% in the number of transactions, not in any dollar value.
But remember, the inventory is down more than 16% from last year at this time. Inventory is probably down 30%. So the fact that transactions are only down 16% when we have 30% less inventory shows there's still strong buyer demand. And we do this market update every week. And we have this thing called the Market Action Index, and the number is in the range of strong seller market, which means that sellers still have a strong market command. And the housing crash, 2006 to 2010, basically, sellers didn't. It was buyer's market for like 5 years. And we still don't have that. We have a strong seller's market.
Now, that doesn't mean that you can price, that if you're a seller, you can price your house for way above market value. No, that's not going to happen. Buyers are not going to part with money that doesn't make sense. It does mean to price your house, at market value. So if you are interested in selling your house, please consider using our services, and we would love to help you.
Anywhere in the country, we have a startup that we're the co-founders of called Referral Cloud.
Yes.
And we can refer you to an agent anywhere in the country. Okay, next quote from the article. That's because sellers who locked in a low mortgage rate before the pandemic began have been reluctant to sell, with rates continuing to hover near 2-decade high, leaving few options for would-be buyers. So end of 2020 and all of 2021, basically, we had ridiculously low mortgage rates, like under 3%, right? So everyone either bought a house or refied. It was mostly refis, okay? But even the people who bought before that, most of those people, almost all of them have under 5% because they had all refied or bought in the last. I think we went below 5% probably by 2011 or 12. So if you bought in the last decade, you have an under 5% loan. Okay, this is the highest increase of mortgage rates, not counting 1981 to 83, when they went from 7 or 8% to 18%.
Right.
They jumped up 10%. Okay. That is not unlikely to happen right now. We had pretty strong inflation back then.
But this is the fastest jump over a short period of time of
rates, right? So we have this sort of people have called it the lock-in effect, but people aren't going to sell. Like people are like, it's might as well own the house cash. So this is what we talked about before. Mm-hmm. If you own an asset cash, you have no reason to sell it unless you have to have liquidity. Mm-hmm. And if I told you, I'm going to give you this asset, it's going to appreciate at 5% a year. But the day you sell it, it's not, you just get the cash and when will you sell it? Well, if I wait next year, you're saying it'll be worth 5% more. Although on average, yes. And so if I wait 2 years, it'll be worth 10% more. Yeah. So you would just go into a calculator and say, okay, in 20 years, what will it be worth? Mm-hmm. And you'll be like, oh, it's going to be worth like 2.5 times as much. So it'll be $1 million. I'll just keep it for 25 years mm-hmm. or 20 years or whatever, right? So you wouldn't, people are making the decision to become wealthy and grow their assets, and they're not giving them up because even with a mortgage, they're about as close to owned by cash as possible, right?
Right. So think about it this way. Let's say that you bought a house and you're going to move into another house that you've bought, and this other house, this was your starter house, and let's say that you maybe bought it with FHA financing, and so you didn't put very much money down. So let's say that maybe you put, let's say you put $20,000 down, a good bit of money, right? And that's really the only money that you put down into it. You've got a great mortgage rate and you're renting it out. That more than covers your mortgage, and you get to put money in your pocket. Life is grand. And let's say that you have a child. Let's say you have a new baby. Congratulations.
Aww, congratulations. Is it a boy or a girl?
That's right.
Or both. Or you probably don't know, right?
Oh, it hasn't chosen.
It hasn't decided.
Yes. So now, remember, you put $20,000 into this house. Now, if I told you that, okay, you put $20,000 in, and when this child is 18, now you can liquidate this house and use all that money to pay for college that you only paid $20,000 for. Because remember, that's the only money you actually put into it. Everything else is being paid for by the tenant. So now think about that. Is that a good investment for you for that child? You have to think of real estate for the long game. And that's a good way of thinking of it, because now that asset will be worth probably in 18 years. So let's say that you start out with $200,000. That asset could be worth, I don't know, in 18 years, certainly $500,000. So that gives you an idea of what that does. Plus, remember, the whole time you're even putting money in your pocket too. So that $20,000 turns into $500,000 in 18 years. Plus, it's been paying you money every month. That's kind of what real estate can do for you. It can put your kid through college with very little money that you put into it. And you don't have to do a whole lot over time. It's just one idea of how you can use real estate to plan for your future or for your kids.
Or better yet, do all of that. And then when your kid turns 18, tell them if they want to go to college, they have to figure it out on their own. And you keep all the money for yourself. And you go on river cruises and just party for the rest of your life.
That's right.
And then the education's their problem. Okay, now you're probably asking this question, okay? Because this is a question we get all the time that people don't understand. They're just like, but 7.5%, nobody can afford that. Nobody can afford 7.5%. Like, nobody can afford that. Right? So let's look at this chart. This is a chart of how much household liquidity there is in the U.S. Now, this is only cash and checkable deposits. This is money you could like, if you needed it tomorrow, you could.
So this is like money in your checking account, savings account, money market, that sort of money.
It's cash. It's cash, right? This is not, I have $200,000 that I put in a stock market that I could liquidate. This is not that. It's not money you have on your HELOC, okay? As you can see from this chart, from 2015 to about 2020, Americans on average had about $1 trillion of cash and checkable deposits. Now, obviously the pandemic, you could see the effect of that had. People started hoarding cash. And then when money got really cheap, they started making sure they had, either borrowed or whatever, but they had plenty of cash. And you can see now the average in the US, there is over $4 trillion. We have 4 times the amount of cash. So when you're saying, well, how are people going to make their mortgage payment if the rates are 7.5%? Well, first of all, you only make this 7.5% rate if that's what you originate the loan on. Because I think there's a misconception that people think that if mortgage rates go up, it's like their credit. People think in very simple terms. Well, if my credit card rate went up, their home rate went up. No, their home rate's 30-year fixed. So if they 1.9%, it's still 1.9%. It doesn't change. Just because your credit card rate went up doesn't mean their home price went up. So everybody's not paying. And you're saying, well, but those 7.5% people. Yeah, but that's a sliver of the market. Because we have 140 million homes in the U.S. and there's going to be 4 million transacted at this 7.5%, but a third of those are cash, right? And then another group of that, probably another half of that is going to be people put 20% down. So you have the small amount of people who didn't put much down, but then in order for them to qualify, they have to have the income to meet they have to show high income. So your average person making 30 grand a year is not out there buying a house right now. They don't have the down payment money. They're not going to qualify financially. So because we have a depressed market, we have only we've skimmed off the bottom people. They're gone. The bottom borrowers. It would be different if there were too many houses on the market and we were trying to find these crazy loan programs just to get people to buy, to get into a mortgage to get the house. So Juana, talk about this, how much liquidity is out there and people are sitting on cash. Like we haven't bought a new rental property in 2 years,
No.
but the rents keep coming in. Cash has got to go somewhere, right? And there's a lot of other people, I think, who have been sitting on the sidelines with their cash, waiting to figure out what to do with it, whether it's investing in the stock market, investing in real estate, paying off some debt.
Okay, so there's a lot of money out there in money markets. So I want to talk about that a little bit.
Okay.
So like Todd said, there's like $4.5 trillion sitting out there between cash and money markets and that sort of thing. But there's a lot of money sitting out there in these money markets that are now paying a little bit of money because they had stopped paying anybody money a long time ago, right? So there's a lot of money out there in these money markets, and I think people are looking for opportunities. These are not people who want to put that money in the stock market because they could have done it and they haven't. I think that there's a record amount of money sitting in money markets, and I think a lot of that is going to end up in real estate.
Yep.
I haven't heard anybody else say this, but that's my sense of it, because these are people who are looking to invest their money someplace that is for the long term, that is going to pay them some sort of a return, both in the long term as far as building equity and in the short term as far as cash flow through rent. So I think there are people looking for that. And I think you see that a lot with these cash purchases of the lower end homes. But I think people are still looking for the right property. I think people are choosy. And without a lot of inventory, I think that money is going to remain in the money markets. I think that when things thaw out as far as inventory, I think you will see these people clean out those money markets and put that money to work in real estate. So you'll see homes being absorbed at an astonishing rate. I don't see inventory building, not in the foreseeable future.
Gen X, who are basically like me at the oldest end and Juana probably at the youngest end. Okay, that generation, we are the more of a risk taker generation. Like Elon Musk is Gen X, and a lot of these tech entrepreneurs are Gen X, right? They're the ones that you've seen. Okay, Jeff Bezos, I think too. He's probably Gen X, right? Because he's about my age, maybe a couple years younger. The millennials and Gen Zs though are far more conservative financially. Meaning that they're not as much risk takers and they like more of, they're interested in more of a sure thing. And I think they see real estate as more of a sure thing. The people that we have met that have bought have been surprisingly putting a substantial amount of money down. They're exceptional savers. Especially the younger millennials and these Gen Zs, they're exceptional. They save a ton of money, surprisingly. They've saved more money than I did when I was, a lieutenant in the Marine Corps. Wouldn't save in anything.
This generation also is earning more than any previous generation at the same age. So that's part of the reason why they're saving more. Also,
as kids, a lot of them went through the great financial crisis. They saw parents lose houses and friends and neighbors lose houses and foreclosures. And I think they said, hey, we need to be financially smart and stable. But I think they see that. I don't think that the good thing is it didn't turn them off about real estate. They saw real estate would happen, but they realized why it happened. And they said, hey, real estate's a safe bet, and this is what I'm going to do. So I think as we move forward, all this excess inventory is just going to keep getting purchased up. Gen Z is going to be by far the biggest homeowning generation in 50 years. Right? And 50 years from now, it'll be the Gen Zs. They'll be the boomers. Like, they'll be the people complaining about that own all the real estate. They'll be the wealthiest generation on the planet. And I think they will hoard real estate. I think your next super, self-made millionaires will mostly be from Gen Zers who bought and held real estate over a long period of time.
Right. And I think, to your point, they're just, I think, more financially savvy at an earlier age.
Right.
Which is a good thing.
Okay. Yeah.
Good thing.
That was kind of it. We just want to talk about housing. We love talking about housing market. You've probably seen a couple of these graphs before, but this new data and stuff, NAR's prediction or that it would be or Fannie Mae's prediction that it would be a year before anything moved. And it's probably right. Something has to give. And right now there's nothing. And maybe we, 2 or 3 years of this. I
think it's going to be a while. I think with an election year next year, I think there's the opportunity for something unforeseen.
Shenanigans?
I'd rather not say that. I just would say unforeseen.
Okay.
For some unforeseen policies that might cause the market to move. But we'll see. We'll see about that. So what do you think? What do you think is going to make the market thaw out as far as getting sellers to put homes on the market? We want to hear from you. You don't have to agree with us. We appreciate your conversation. Remember to like the video, subscribe, hit the notification bell, share the video, be nice to one another in the comments, and we'll see you on the next video. Bye.
Bye.